Our guest today is Jim Jubak, Senior Markets Editor for MSN. Welcome, Jim.
Glad to be here.
Many of our viewers may not be familiar with the peak oil theory. Can you give us an idea what it means?
Well, it's especially interesting to talk about right now because today we had Exxon come out and do really good earnings but miss. And that's wild. I mean, how can this be possibly happening? And the problem is there really isn't enough oil in the world to be driving the reinvestment of the oil industry. And peak oil basically says, hey, look, at some point when you've extracted about 50% of the total available conventional resources, you start to see a decline. You can't get to 60 to 70%. You can't keep pushing up production. And what peak oil has said is that we're somewhere close to that we're seeing the peak of oil production. That doesn't mean that we're about to fall off a cliff, but that we're not going to be able to push production from conventional sources a whole lot higher. The question is when that might be, and we're talking really about a difference that doesn't make much difference. Some people say we've already seen it was in 2005, some people say 2010, but in the terms that we're dealing with here as investors, that's not significant. The important thing is that it's getting harder and harder to find oil to increase production, and that means that the oil companies have this really bizarre problem, which they've got a lot of money now. Where do they put it in the future?
And where do you think they are going to put it?
Well, I mean, Exxon's a great example. Exxon is going into the natural gas business in a big way, and especially liquefied natural gas. They've got big projects underway in Qatar to turn that gas into a fuel that can then be shipped all over the world. Because the thing about oil that makes it really so important to the world economy is that there are uses that you really can't replace. The transportation sector is a huge problem. What do you run cars on? So Exxon is saying, well, maybe we'll use liquefied natural gas for some of that. We can certainly already do it on buses. And then we've got a problem of how do you move it from one place because you can't ship it except by pipeline or unless you super cool it and then put it on a tanker.
Yeah, several variables there. So, but the bottom line with the peak oil theory is that whether it's already peaked or whether it's peaking in 2010 is that you see a shortage in crude oil for forever.
Well, that if you look at what's happening is that as you sort of drain the existing reserves, you take oil out that has a production cost of, I don't know, Saudi oil, $4 a barrel, and you replace it with oil that's got production costs of $30, $40, $50, $60 a barrel, like the Canadian oil sands. And what that does is it says to you that, hey, this is not simply a blip in oil prices that's short of some radical diminution of demand, like a economic slowdown of big dimension. You're seeing these prices at this level for a long time because the resource cost is going up as the sort of resource base shrinks.
Very interesting, Jim. Thank you very much for your comments. Thank you for joining us on the MoneyShow.com video network.